What's up, everybody? Welcome to Heresy Financial. Just a quick video. Today, I wanted to talk about the relationship between gold and interest rates because we saw interest rates spike today. At one point, the 10-year was up to, it was up like 16% just today. And rates have been going up the last few days. And so rates and bonds have an inverse relationship. And the typical narrative is that real yields are what drive the price of gold, right? And so the relationship there exists because just from a basic level, if you hold cash, right, there's no return on that. So long-term cash or large amounts of cash, if you hold it in the risk-free, the sovereign debt, you're going to collect a little bit of an interest rate to compensate you for the time that you're locking that cash up. And so when real yields are not the same as what the yield says, what the interest rate says, the difference there is going to be inflation. And so if inflation is, let's say, 2% and the stated yield or the nominal yield is 2%, then your real interest rate is negative 1% because your dollars are losing 1%. Or your dollars are losing 3% every year, you're getting a 2% return in interest rates on those dollars. And so your real return is negative 1%. At the end, once you compensate for that interest, they will go 1% less as far as they did before you made that loan, before you purchased that bond. And so in an environment where the real rates are, where the real interest rates are negative, that means that gold, which doesn't have an interest rate, is technically a positive interest rate relative to everything else that is, cash that's a negative interest rate. And so when you have, the typical narrative is that real yields are what drive gold. And so we had a spike in interest rates at one point, like I said today, the 10-year, or maybe it was the 2-year was up 16%, but the 2-year ended up at right around 10%. Higher than it started the day off, and all the way through the 30-year. The 30-year was up I think 6 or 7%. Maybe it was even up at 8%. And even in any case, whatever it was a massive spike for one day. And so we also saw a little bit of a sell-off in gold. It was down about 2%, and then it rallied towards the end of the day here. And so basically the narrative held true for the short-term trading, right? If yields spike, let's say real interest rates are expected to go positive, well, then that would theoretically be negative for the price of gold, right? Because if currencies have a positive yield again, then something like gold, which has no interest rate, it would be bad for it, right? Well, this is something I've been talking about on this channel forever, but our government is insolvent and our economy is insolvent. The debt load on both private and public debt loads are so large that the only way they can keep going is by rolling that debt over. You have to take out new debt to pay off the old debt and to finance your current spending. This is true of the broader economy as well as the government. And so if rates spike to a point at which that debt service cost, paying off the old debt with new debt becomes too high, there is no choice. The Federal Reserve has to step in and increase their bond purchases, whether that's, increasing the same bonds that they're buying right now or opening up a broader scope of debt that they're buying. Whatever it is, they have to increase the purchases because, like I said at the beginning, the relationship between interest rates and debt prices are inverse. And so they'll buy the bonds to push the prices up. That pushes the yields down. That's the only option, unless they want to allow the economy and the government to go bankrupt and not be able to service its debt, which I guess is theoretically, that is a possibility. That's the scenario in which you get a deflationary death spiral. That's the insolvency collapse across the board. The other option is to just print more money, to buy more bonds, to keep rates low. The reason rates are spiking is because inflation expectations are going up. And so as people expect more inflation, the market is going to demand a higher interest rate on their debt. Otherwise, why would you loan money out and receive that money back at with an interest rate that technically pays you back with less purchasing power than what you originally lent. You're not going to do it. So this is what I've been saying for a long time. At some point, even in my last video, it was a couple of days ago, I made a video about 10 things to expect in 2021. I said in there, we're going to see some short-term rate spikes, and then we're going to see yield curve control come in, and they're just going to have to basically absorb the entire credit markets. And you see rate spikes happen when inflation expectations rise. So inflation expectations have been rising. We saw rates spike today, and people, traders, really, algorithms thought that that's bad for gold. But the end game is the rates have to go back down. More money has to be printed, more asset purchases have to happen in order to delay the insolvency as long as possible. That means that the real rates go even deeper negative because the inflation still happens. The inflation's still there. It's just that the debt prices and the debt yields cannot accurately reflect that because you have an infinite money printer keeping those rates suppressed, keeping those bond prices high. So the market prices in the credit markets, they can't reflect inflation expectations. That means that real interest rates go deeply negative, which, remember the relationship between gold and interest rates? It's gold and real yields, not gold and nominal yields. So real yields will go deeply negative. That is very, very bullish for gold. And so what happened today, largely noise. Rates aren't going to spike up to obscene amounts. They're definitely going to step in if this rally in interest rates continues. If yields keep on spiking, they'll they're going to step in. They're going to put a limit on that. So that's my thoughts for you today. And if you haven't built your position in gold or even silver yet, feel free to check out OneGold. I have it linked in the description below. That's who I use to buy gold. I like them. They have allocated and segregated storage. You can choose the country around the world where you want it. And you get $5 free if you use my link in the description below. As always, thanks for watching. Have a great day.